This podcast is proudly brought to you by Term Plus. What I like about Term Plus is its easy to use online platform, giving you access to high-yield term-based accounts, providing consistent monthly income. Owned and operated by Pengana, an ASX-listed company with 23 years of experience, Term Plus is democratizing access to global private credit markets. Visit termplus.com.au to learn more and read the PDS before investing.
So, Judy, tell me, where did you grow up?
I grew up in the Blue Mountains, so that's about 2 hours west of Sydney in New South Wales.
What part of the Blue Mountains?
A beautiful sort of pocket, which is about halfway up the mountains, sort of like Wentworth Falls, Katoomba, Leura, sort of like tourist hotspot or corporate retreat hotspot. Really beautiful, a view of the Jamison Valley, the Three Sisters. It was a very idyllic childhood. I was very lucky to grow up there.
Oh, that's fantastic. If I was to go back there and I was to spend 24 hours there, what are the must-dos? What are the highlights?
Now, this is a very biased recommendation.
That's what I want.
Because I am the daughter of a railway engineer. And the Scenic Railway, which is in Katoomba, is the steepest railway in the world. It's 125% incline.
Wow.
Which is about a 52-degree angle. You're basically vertical down the side of a cliff. And it was an old mine railway that used to bring slate and other materials up from the bottom of the Jamison Valley up to, the top. And they've since turned it into a tourist destination. It's sort of half railway, half roller coaster. Definitely a tourist attraction, but it's beautiful. It's a really beautiful thing to do.
Okay, well, I'll put it on the list. My 3-year-old is obsessed with trains, and my sister lives kind of at the base of the Blue Mountains I can't even remember the town name. There's a little train station there. But that's
Penrith?
No.
That's further out.
It's further out. Gosh, I'm in trouble now. She doesn't listen. It doesn't matter. So, Euphemia, you're the CEO of a family office. Does Euphemia take outside money, or is it just the money from Dom Pym and his family?
The best way to describe it is that Euphemia is the family office of Australian fintech entrepreneur and investor Dominic Pym. And Dom is most well known for building Up, which is Australia's most successful digital bank. He sold that along with his business partner, Grant Thomas, in 2021 to Bendigo and Adelaide Bank. Today, Dom still remains the largest individual shareholder of the bank. And so Euphemia is his personal family office. So our mission is to go big and grow home. Now,
hold on, go big and grow home.
Correct.
Where'd that come from?
Well, both Dom and I are deeply passionate about the Australian startup ecosystem and maturing that in an unreasonable time frame. So to do so, we have to go big. We have to have really big ambition. We have to have bold ideas. We have to have great technology. But we also have to have a mind for our own backyard and to grow our home base. For years, if you've wanted to be successful, you've had to basically flee Australian soil to go and work in the Bay Area, Singapore, London, etc. And we would love to see more of our Australian talent be able to do so from Australian soils. Our market is small, so you'll always have to serve international markets, but we'd love to see a world where you don't have to change your company to be an American company or another region to be successful.
So how does someone go from the Blue Mountains to being the CEO of a family office?
That is a very long story, but the short version is that I've always loved working with people. And when you're investing in private companies, it's very different to investing in listed equities. Listed equities is a lot about research and company data, and these companies are public, and so they're governed and have to meet a different standard of disclosure, and rightfully so when they're dealing with retail investor monies. When you're dealing with private companies, it's a different set of obligations around disclosure, and what you really have to go off is the trust and relationships that you have with the founders, the executives, the board, the staff, the team, the customers. So working with people and understanding relationships is something that I've always loved and always have been very good at. So I'm not an investment banker by background. And for the longest time, I kept trying to convince Dom that his CEO should be someone that wears a pinstripe suit. And I lost that battle. But years down the line now, I understand why I was the right fit for what we're trying to achieve.
Excellent. So you were previously at, and I'm going to get the name wrong because it's changed, but it's Startup Victoria?
Correct. So prior to teaming up with Dom, I was the CEO of Startup Vic, which is now known as the Startup Network. That's Australia's largest startup community. So it's got over 75,000 people in the network. So if you're a founder and you're looking to build a business, it was my job to help you go from idea to exit and everything in between. Bootstrapped, fast growth, slow growth, venture-backed, B2B, B2C, you name it. And Dom was one of my members. So I used to run a meetup for scale-up founders in Melbourne. And so we'd get together once a month for dinner. We'd have bi-monthly education events where you could learn from others and see around a corner. And we just got to know each other over the years. So all came from community management, really.
So what type of businesses would be involved in that?
Well, it's a catch-all for everything. Think of it like a peak body. So if you're a tech founder and you're building a startup and you're trying to grow really quickly and you're trying to either find customers or put your MVP out in the world and test it with customers and find product market fit, or you're looking to attract investment from and you need to meet VCs or find angels, or you're looking to scale your company, maybe you need support figuring out how to open a bank account in the US and you've never done that before, or you need legal advice but you can't quite afford that very expensive lawyer yet. The Startup Network is really a place where you can go where you don't yet know the answer. And because just by the nature of being a part of the largest community in the country, there's always someone in the Slack channel, at a pitch night event, or a piece of content that's being distributed in the weekly newsletter that's going to help answer that question for you. So it's really designed for anyone and everyone who's interested in building a startup, working in a startup, investing in a startup, or buying a product from a startup.
Right. So I've also heard you describe Euphemia as a network-powered family office. What do you mean by that?
We are so built on the back of what everyone else is doing. So Euphemia is only successful if everyone that we choose to work with is successful. So it's a pretty great joint incentive. So our tagline is make awesome, because Euphemia, it's not about us. It's not about the work that Dom and I do. It's about the work that every person that we invest in does. And so if they succeed, we succeed. The other thing is that so many of our great deals are sourced through the network of people we've either worked with before, employees at companies that we've run or built, their former staff members, or their 1 degree removed from someone like that. Now, that being said, you can't actually succeed purely on being a network-based investor, because the risk is that you have a complete bias to investing in people that think like you, talk like you, look like you, because as humans, we like. And so why that can be a problem for venture investing is that we know that the women and non-binary founders, or any founder from a diverse background who hasn't had equal access to opportunity, is they're less likely to have those networks, because we know in the last, this will definitely timestamp this recording, but in Q2 of 2025, we saw less than 0.5% of the investment capital that was given to Australian startups go to women-led companies. The rolling average for the last few years has been about 2%, and that is the fastest drop in the amount of capital going to women-led companies that I've personally ever seen. And so if we only are investing in the front door isn't really open for someone that doesn't think like me, doesn't look like me, and doesn't talk like me. And so whilst that's definitely our natural style, is investing through the network of people that we know and have done awesome things already, we always need a sign at the front of the shop that says that regardless of who you are, if your business matches our investment thesis, then we'd love to hear from you. So we have that on our website. Anyone can pitch Euphemia, and there's an automated smart workflow that tells you whether or not you'd be a likely fit for us, so we also don't waste your time.
That's cool. Let's talk about the Euphemia investment process and the portfolio as a whole, because it's not just venture capital. So can you tell me about the actual portfolio that you're managing as part of the family office, and then we'll get into the investment process behind that.
Sure. So the family office includes a venture portfolio, which we can talk a little bit more about, a property portfolio, a share portfolio, which is mostly listed US mega cap tech stocks, and a foundation to help people in need. So if you think about those 4 buckets as sort of the main things that the Euphemia family office does, so venture, property, public shares, and the foundation.
Do you know off the top of your head roughly the split?
Oh, yeah. We are the opposite of every traditional family office you've probably ever met. So, and the reason why is important. So we are a first-generation family office born out of tech wealth. So it's Dom's family office, and he's a 20-year-plus veteran as a tech entrepreneur. He's built several companies. Before it was Up, it was another fintech, Pin Payments, which sold to Checkout in Europe, which is Stripe's biggest competitor in the region. Recently got resold to Fat Zebra. So he sold it twice now. And then before that, he built Clear, which was the world's first digital grain exchange, which sold to the New Zealand Stock Exchange. Before that, he had a record label. He's toured the country with Delta Goodrem and John Farnham and a whole bunch of other awesome artists. He's lived and worked in London, Singapore, and was coding at SAP in Silicon Valley when there were cows still in the meadows, and this was before Google was founded. So Dom built his family office from the ground up through the School of Hard Knocks, both as an entrepreneur and as an investor. Now, that matters because we're not a multi-generational family office. And if you're a multi-generational family office, typically you have this undercurrent of being a custodian of wealth as opposed to the creator of that material step change in wealth. And because Dom has been the creator of that, and because he's an entrepreneur, naturally what goes with that is a very high risk appetite. So when you ask me what's the breakdown across those asset classes, if you spoke to a normal, traditional family office, you'd probably have a pie chart and one slice. Australians love property, huge section for property. We love equities, good chunk for equities. We love cash, some income generating products, fixed income, some bonds, some debt, blah, blah, blah. And then venture would sit within the alternatives category.
Maybe 10% kind of max.
Maybe if you've got a high risk appetite, right? If you're really pushing it, you'd take it to 20. But often we see 2, 5, it's just I don't know a lot about that asset class. It's high risk, high reward, but I'm sort of happy if it all goes to 0 kind of allocation. Now, Euphemia is over 80% invested in venture. We have an ultra high risk appetite. The property portfolio is part residential, part commercial, and they all have personal reasons for existing. The share portfolio...
When you say personal reasons, you mean they've been brought into they've been properties that Dom has owned and have been just brought in because it's convenient to have them under that banner?
Every property within the portfolio and the property group, both residential and commercial, it's either a legacy asset that already existed, or it's an asset that's been acquired because there's a deeply personal reason to have attachment to that property. It's not like we're going out and doing multi-million-dollar property developments or investing in property funds. And it's just not what we know, right? It's not what we know. It's not how we came to be. But there is some exposure there, and it is still professionally managed.
And they've got a role in the grand portfolio.
Correct. And we do have wealth advisors who help us to not be entirely insane. And the share portfolio, Dom's first ever job was actually writing software to trade on the ASX. So he's very good at it. That part of the group is more giving us exposure to a completely different end of town. So as I mentioned, we invest mostly in mega cap US tech stocks.
So we're thinking the Mag 7 kind of style there? Or
totally. I'm hesitant to say any individual company because you never know. But think like mega cap tech companies, mostly in American stock exchanges. And it's a completely different strategy. And then in venture, because it's most of what we do, you can actually break down venture into several categories. So we have direct investing, where Euphemia will write a check into a private company that's a high growth, fast growth tech company, and we'll go to the earliest of stages. So pre-seed up to Series A, which is really, I've got an idea, all the way through to I've found product market fit, customers are buying my product or service, and now this is really just about injecting capital to scale. Then we'll invest in funds. So that's where we'll allocate some capital to a fund, and then they go on to make those investment decisions. And those funds, we're now in 23 plus from pre-seed to private equity, both here and abroad, including a lot of emerging managers in Australia. And then the last category is in the venture portfolio, but it's not just Dom's money. Now, I know I didn't really answer your first question, which is, do you invest other people's money? Now, the Euphemia family office, that is Dom's personal capital. But within the group, in the venture portfolio, there are two ways that other people can invest alongside Euphemia. The first is through what we call the Euphemia syndicate. So that is for sophisticated investors only. So it's not for retail investors because there are a whole bunch of regulations that come with that. But basically, if you're a sophisticated investor and you like what we're investing in, we will share on a deal-by-deal basis our allocation into that capital raise. And so you can come in and invest alongside us. Now, we run that syndicate on a platform called Aussie Angels, which is kind of like AngelList for Australia.
Yeah, I'm familiar with it.
Yes, Cheryl Mack's the co-founder and CEO there. And so that's one way, and that's deal by deal. And that's typically against Euphemia's thesis, which I haven't spoken about yet.
We'll get to that.
And then the other way is through Triple Bubble. Triple Bubble is a separate brand, a separate business, and a separate fund. So that is a fintech specific, stage agnostic, first of its kind fintech fund for our region.
Cool. Let's get into then the actual investment strategy and the philosophy that's underpinning and brings all this together. I believe you guys have 3 core categories that you like to invest in. So fintech, as we've clearly mentioned, and now having the background of Euphemia, that makes complete sense. Invest in what you know. Secondly is climate kind of venture capital. And then the third is focusing on women-led businesses, women-founded businesses. But underpinning those, surely there's an investment philosophy that, there's boxes that need to be ticked to make an attractive business within those categories. Can you maybe take us through from the top level, and we can get into some detail into the actual investment strategy that brings all this together?
Yes, and I'm going to give you a 4th bonus category,
cool.
which is something that we've learned over the last few years that we like to do, but we didn't originally define. Now, the other thing I should say is that because Dom's been investing for over a decade, it was sort of like PIM Enterprises, in air quotes, before it was branded as Euphemia. But because he had the up exit, the PIN exit, and he was also an early investor in Afterpay, and that transaction to block was the largest corporate trade deal in Australian history, not just of fintech.
So he was involved in Afterpay as well?
Only as
an investor,
a minority early investor. But those 3 exits, and he was also an investor in a UK fintech called Nutmeg. Those 4 transactions all happened in the same year.
Nutmeg's like a robo-advisor.
Yes. But they all 4 led to the, just when it rains it pours, 4 transactions, and all of a sudden, boom, there's the impetus for the family office. Now, the thesis is really exactly as you say. What do we know really well, where we have an unfair natural advantage that can try and take the edge off of the risk that we're taking by being in the venture asset class? And then what do we have just an impetus to must do? We don't necessarily know a lot about it, but we know we want to have an impact there, or we know we want to learn something about it. So that led to the creation of the thesis, which is fintech, anything that's going to help fix money. That is Dom's wheelhouse. He is definitely known as the fintech guru. Like, he was fintech leader of the year twice in 2022 by 2 different organizations, and then C-suite leader of the year by the Pause Awards the same year. So he's definitely known as the fintech guru in our industry. So it makes sense. We get great deal flow. the Up brand and growth story and partnership with Bendigo is a case study that a lot of other fintechs seek Dom out to provide some mentorship on. So a lot of fintech founders want Dom on their advisory board, their cap table, their mentor call list. So we get great deal flow in fintech. But Dom can also do due diligence on a dime. So we can very quickly assess the mettle.
Yeah, what's
he
looking for there?
Oh, my goodness, how long have you got?
We've got all day.
Well, Dom can do it very quickly, and then I sort of come up behind him with a dustpan and broom and make sure all the I's are dotted and the T's are crossed, so we're a good combo. It depends what stage you're at. So at the earliest of stages, there's not much to assess. You're really assessing the founder or founders in the team or their early employees. You are assessing the problem that they're trying to solve, the size of the market, who would actually pay money for that. Does the business model make sense? Is the timing right? The competitive landscape, the technical capability. So you're really diving into tech due diligence, governance due diligence. You know, fintech is a highly governed space in Australia, which if you can build a fintech in Australia, you can build one anywhere in the world. We have great oversight from our regulators to protect consumers, and rightly so. And so we need to make sure that is buttoned up. And then you're really looking at, are they well capitalized enough? So often in Australia, founders don't raise enough money, and we can talk about why that is if you want. But basically, do they have enough money to achieve their goals? Just to get started. There's lots of other things, but typically people, vision, size, and execution risk.
And when you're looking at people, what are you doing? Are you sitting down and just having a conversation? What does it look like?
So at Euphemia, we have a secret mission. So I told you before, our mission is to go big and to grow home. Our secret mission is to create more Euphemias. So what that means is that when we're investing in founders at the earliest of stages, we're trying to squint and figure out, is this the type of person that if they are successful and they sell their company, or they list their company, or they turn into the big company that just is private forever and gobbles up other people and pays dividends, whatever it might be, when they have that material wealth event and they could create their own family office, will they sail off into the sunset and go buy a super yacht and, you know, go hang out in some other place, you know, for their sunset time? Or will they reinvest back into the Australian startup and venture ecosystem? Will they be an active participant, both as an investor, a cheque writer, and as a mentor to the next generation of Australian founders? Now, you can ask that directly, or you can get a sense of that indirectly by asking other questions or watching their past behaviour, or seeing how active they are, or looking at, do they mentor? Are they a mentee? What does that look like?
Can we get an example of one of the questions? Not to give away the secret sauce.
No. It's fine. It's fine. So maybe one example is a company we've already spoken about. So if I take Aussie Angels as an example, that is a platform that helps people run angel syndicates. So if you're investing in a startup and you want other angels to invest alongside you, it's the platform that you would run those deals through. Now, when we led their pre-seed round, it was about $1.6 million in 2022. Cheryl had, as part of her pitch deck, a vision, even though she was literally going from a stack of no-code, low-code, cobbled together type forms and Slack, and like it was not a tech-based platform. It is now, but it wasn't at the time, very tech-enabled. And so at the earliest of stages, she didn't even have an AFSL at that time. She was licensing one. And already in her pitch deck, when she was raising her first lick of capital, she already had articulated, when I am successful, in however many years she was forecasting, here's what I'm planning to do with all of the profits from the company. We'll pay dividends and distributions to our shareholders at this kind of rate, but we've already set up or made plans to set up within our structure a foundation so we can actually flow through and provide grants to the Australian startup ecosystem, and we can help more people learn how to become angel investors, create access pathways for the asset class, and educate founders on how to do good cap raises. And the best ones, you don't have to ask, because it's already obvious that they have that mindset of a give-back mentality for our ecosystem.
Can you give us a few examples about the types of businesses that you invest in along the climate side of things?
Yes. So we've spoken about fintech, anything that's going to help fix money. Climate tech is the next bucket of the thesis. Now, that's anything that's going to help fix the planet. So the climate tech portfolio has, at the moment, it's like 30 plus investments in all sorts of different categories, from wave energy to agricultural vertical farming to a honey company in WA to all sorts of weird and wacky things. I won't bore you with the full list, but it's a very broad space, climate tech. And you could probably spend the rest of your life becoming an expert in just one subcategory. Maybe it's energy, maybe it's agriculture, maybe it's solar, maybe it's green mining, like whatever it might be. You could spend the rest of your life trying to get good at being able to do due diligence and source deal flow. Now, why it's a part of Euphemia's thesis is, for us, we feel like we have to. I often describe my job as well-directed abundance. And when you have well-directed abundance, there are some topic areas for us personally. It just feels like it was a no-brainer. We didn't even have to talk about it. It was just in. The question becomes, how do you do it in an impactful way? So how do you maximize the impact of that capital? Because we don't have enough money to fund all the climate tech in the world.
But also, is there, I'm sure, an element of, because it's a fund at the end of the day, that you're wanting to continue to grow that family office wealth, there must be a commercial element to it as well. So there's impactful plus, hey, this has actually got to generate money so we can get maybe an exit or yada, yada, yada.
Yes.
So we can continue to grow what we do and help more and more people.
Yes, a great example, and absolutely, right? Like a good example is an American-based climate tech revenue fund called Enduring Planet. So they provide financing. So they're basically a debt provider or a interim debt provider for climate tech companies in the US, where they have reliable revenue on the books. Maybe it's a contract with a government provider that's a secure contract, or maybe they have a grant and they're just seeing out their milestones, but it's secure revenue. So whatever it might be, they'll either do grant advances or debt based on their revenue. And that's not a climate tech, but it's a fintech serving climate tech companies.
So it's right in the wheelhouse.
Yes, exactly. Yeah.
Oh, that's cool. And let's get into then the women founders side of things as well. What type of businesses can you tell us about there that you guys have provided capital for?
So the women part of our thesis is supporting not just female founders and non-binary founders, but also women capital allocators. So these are the funds that are run or owned by women. So it's a pretty broad...
Yeah, it's broad remit.
Yeah,
that's
remit,
cool.
Which gives us flexibility to basically invest in the best fund managers and the best female founders. Now, I'm going to cheat, because I don't want to get these stats wrong.
That's all right.
Because I know people talk about this a lot, but they don't often name the sources.
Yeah.
And I do think it's important to get it right. So, of course, we're investing in women because there's a gap, right? We already spoke about the investment gap, and there's alpha in where no one's looking.
Yeah, that's exactly right. So where there's no capital flowing, then there's opportunity. You can sift through there and just get the best of the best opportunities.
Correct. But to your point, there's impact and there's also commercial gain. And these are the points I don't want to get wrong.
Right.
So the first is around revenue efficiency. So startups that are founded and co-founded by women, they generate around 2 times more revenue per dollar invested. And that's from a Boston Consulting Group study of around 350 companies. The second is they actually outperform their all-male counterpart teams. So First Round Capital did a 10-year study, and they found the companies with at least one female founder outperformed by 63% compared to their all-male founding teams. So that sounds pretty good so far. So number one, we know they're capital efficient. I mean, arguably because they have to be. And we know that they outperform. Now, but what does it mean for cash on cash returns? Because you might have a big company, but can you actually liquidate that and give that return back to your investors? So particularly in emerging markets, PE and VC funds with a gender-balanced senior investment team, so this is where we're talking on the fund side, it's not the companies, they produce 10 to 20% higher returns the majority male or majority female teams.
Okay.
So that's quite interesting. The last one I'll give you is how quickly do you get to that liquidity? So the last one, which I think is particularly fascinating in this current market, obviously with the interest rate environment, people like liquidity, they like options. And so UBS summarized Boston Consulting Group and some other market data, and they noted that women-founded startups reached exits faster. They achieved a 6.7-year time frame compared to the 7.7 market average. So
some good stats.
I just wanted to get all that out there because you do hear the broad sweeping statements a lot of the time, like, oh, women are more capital efficient, or women, they actually deliver better results, but like there's some of the more specifics under why that is. Now, yes, it means that we get to go fishing in a very, very big pond, but it also is challenging because, again, we can't do all of them. And so we can't do it alone. So I guess my ask is to your listeners who have just heard all of those stats, I would ask them to reflect on if they have any biases that might be holding them back from investing in mixed gender teams or women teams, because already you can tell that the research is saying if you just shift it a little bit to one side on the gender investment spectrum, you'll get a better result.
Are you able to tell us some of the funds that you invest in?
Of course.
Yeah.
Now, I know that there are a lot of disclaimers on your podcast, but I will say of that.
There is a disclaimer that runs right at the start.
Totally. This is not investment advice. I'm not a financial advisor. This is general in nature. All of that.
Good disclaimer.
Yes. But some of the funds that we have chosen to invest in include Euphemia. Euphemia is a Californian-based VC fund. They invest from pre-seed to Series A in tech companies that are co-founded by women, majoritarily owned, in both Australia and the US, serving the US market. So that's a fantastic one that's run by a woman called Marissa Warren. She's an absolute gun. She built Alavaco Accelerator for women in New York. She's incredibly well networked, and they've got some deep pockets behind them as well. Some others would be mixed gender VC funds. So, all of the big ones have mixed gender investment teams in Australia. So Airtree, Blackbird, Square Peg, Blackbird New Zealand, like they all have mixed gender teams, which is fantastic. And then we have some mid-market teams or emerging fund managers. One of my absolute favorites is a woman called Maxine Minter. So I've
heard that name.
You've heard Maxine?
Yeah, I don't know where I can place it, but I definitely know her name.
She was Australia's first solo general partner dedicated pre-seed fund in Australia. So if you're investing exclusively in pre-seed, so at the very earliest of stages for private tech companies, and she would serve similar to Euphemia, either Australian founders operating in the US or like serving customers in the US, either from Australia or in the US. So she spends half of her time in the Bay Area and half of her time in Sydney. She's just phenomenal. She's just done Fund 2.
Okay. So what I now want to do is take these lessons that you've learned from investing in venture capital, in the direct companies, and also in the funds. And how would you, say, apply some of those lessons to public investing, or how do you guys apply them to your US listed equities, some of these lessons that you've taken away from that?
There's really only one, because otherwise I would say none, because they're so different.
Right.
So different. And I think I've already given the answer, which is that in venture and in startups, whether it's a fund or a company, you really are investing in people and your belief that they have what it takes to execute and to win, that they're going to outlast, they're going to beat the competitor, they're going to beat the change in technology, they're going to fix that tech debt, they're going to solve for that runway problem. Like, you actually just believe that that person can solve every problem that you don't even know exists yet. You're really investing in your belief in that person's capability, or people's capability. When it comes to a publicly listed company, that would be an insane way to invest. You could do it, But it would be really hard to get that data, right? Because, the executives and the board, maybe they have...
they're definitely at arm's length.
Yes, exactly. Very hard to read that. And also their power is diluted, because of governance and the size and the scale of these companies. So, I don't actually think there's a lot of transferable lessons. I think they're very different asset classes with very different investing styles.
That's a big reason why a lot of public equity investors go for founder-led businesses. So ones that have listed, et cetera, and because I know there's a lot of data out there to suggest that founder-led businesses certainly outperform the, your typical CEO for hire type, C-suite for hire type of people.
Some of the best setups I've actually seen as a company scales is it's actually quite rare. What you're talking about is very rare to find a founder CEO archetype that can scale and grow with the company through all of those seasons.
Yeah, there's not too many. There's not too many of them.
It's very hard. And some of the best founders that I know have fantastic self-awareness on when they're no longer the best thing for their company.
And I think that's a really difficult one because you do see instances, say on the ASX and whatnot, of founders running very large ASX listed or just publicly listed businesses and still running them like it's just their own and without those other shareholders in mind. And they do come unstuck in a corporate governance manner. But yeah, sorry, go on about the
well, that's where I think good governance does play a role, right? You still need good governance even at the earliest of stages. You need a great constitution. You need a great shareholders agreement. By the time you get to the stage that you do need a board, you need to think very carefully about the rights of those directors, the makeup and composition of the board charter.
This is all part of your due diligence. Like when you say
Yes.
we're looking for someone who's exceptional talent and great people, etc. That is the X factor, and then you've got a big deep checklist. Because I reckon I've listened to a few podcasts that you've done, and I think you've probably, stop me if I'm wrong, but have probably a Notion board or something with all sorts of checklists and stuff like that in place for heaps of different aspects of your job.
Yes, we do have a due diligence checklist, and I'd be happy to share it with anyone who's curious to learn more. You can just message me on LinkedIn. We're happy to open source it. But it's basically a I need to prove myself wrong list as opposed to I need to prove myself right list. Because by the time you get to investing in the due diligence, it's a lot of work.
So you got it. Yeah. So you're
you've already decided that you want to.
Yeah. Right.
Now you need to prove whether you should.
Yeah, just because you could doesn't always mean you should. So
exactly. And sometimes you do find things that are, and it's either one of two things. It's either something that's not quite ideal. Is this something we can work with the company and the team on to get it to where we'd like it to be? Maybe it's just a sheer, we haven't even thought about that yet, but that's a great piece of feedback. Can we build that together? So for example, sometimes you don't have founder IP assignment deeds, right? And so sometimes people are building so fast, they haven't even thought to assign the IP that they created in the product before they incorporated the company.
Right.
And so I know that sounds crazy. It's a tiny little legal thing, but it's let's just make sure we've got that buttoned up because, if in the event that this all goes sour, that's all fine. All of the IP lives with the company and it's not your personal IP. Just a tiny little thing that if you're a technical wizard, you do not
No, you're not thinking about that.
You do not care. Yeah.
Are there some common red flags that make you step away?
Yes. A common red flag is inconsistency. So
Just
inconsistency of what someone's telling you and then what you're seeing in the documentation. So say, for example, if in a pitch deck someone's telling me that they've got 18 months runway and the burn rate is X and, they're forecasting profitability by Y, and then you go into their data room, which is basically, where they keep all the information for you to check that what they've told you is actually what you're seeing, and you're looking through their zero exports and you do your own modeling. You're actually runway's only 6 months and their burn rate's actually this, and they're going to run out of money in 3 months and they're only raising this much. What's going on here? That is something that you definitely look out for. So you're looking for consistency. So what they tell you is the same as what's in their spreadsheets, what's in their pitch deck, with what's in their email. everything should be, data validity. Like lots of data points pointing in the same direction is increasing the likelihood that that data is reliable.
Is there any other common red flags?
Previous investors, or previous people involved with the team. So
when you go out and talk to them.
Yeah, so if we're investing in a later stage round, for example, what we're typically looking for is who else is investing alongside us. It's just one variable. It's not the make or break on whether or not we'd invest, but it's just one variable we would consider. So let's say, for example, a founder has raised a Series A and they're now doing a Series B, and we ask them, who are your investors in that Series A? And they say ABC. And we ask them, well, are those people following on and investing in the Series B? If the answer is yes, then, tick, high confidence. The people that came before who've seen it all, they've read every investor update, they've had information right, and they're still following on, that's potentially a good sign. But if they've decided not to follow on, then we might want to ask why. Maybe it's completely nothing to do with the company and they've just maxed out on their capital allocation, or they've decided to do something different or whatever. But if there's something there, then we'd want to understand why.
So I now want to get into as well some of the mistakes, because investing, it's a game where if you get 60% right, you're one of the best at it. So,
but you won't know for 10 years.
Yes, but you won't know for a long time. So can you tell us about maybe some of the mistakes made along the way and lessons learned? Because I reckon you've probably put all these frameworks kind of develop around that. Like, hey, this happened. This was probably a red flag. Let's put that in our due diligence checklist.
There's so many. I mean, we're only any good because we messed it up the first time or the 5th time or the 20th time, we could do a whole nother podcast on everything that I've failed at or that we've failed at Euphemia.
I've done one of those.
There's heaps. There's heaps. And gosh, where to start? Check size, right? So making sure that you're investing at a check size that's the right size for that. So for example, we did one deal very early on. We had high conviction in the founder, high conviction in the team, wrote a massive check, and sort of unknowingly became the lead investor for that round. But we hadn't done a level of due diligence that would justify us being called the lead. Just because we gave them a big check didn't mean that we did a big due diligence.
So what's the significance of being called the lead?
So a lead is an industry term for basically you have worked with the company to price the round. So you've helped basically be the first to say that these terms are appropriate. It's the right price, it's the right share price, it's the right settings in the contract, whatever that might be, a SAFE or a subscription agreement, whatever the deal is, you're saying that price is right because I've done all of this due diligence and I, based on that work, can say this is a fair price for us and for the company. And what typically comes along with that is either a big check. So you're typically taking 25 to 50% of the round. So let's say if they're raising $1 million, then you're investing $250,000 to $500,000. And you've done the due diligence. So you're typically named as the lead. And so then let's say you come out as the lead, you're typically first and then everyone else follows you. So
these guys have done the work.
Exactly. So let's say, for example, Euphemia says, hey, we've led this round, we've done the due diligence, we've priced it. So if you want to follow us, we've already done the work. Of course, everyone should do their own due diligence.
Come on in, guys. The water's just fine.
And so the company gets to say, hey, we've secured a lead. And then it's also a very common, not a lot of people lead because, well, number one, it's a lot of work. And number two, it's a lot of pressure to get it right. And you do have to have the expertise and the access to the market data to know that you're doing the right price.
So you accidentally became the lead?
Once. It hasn't accidentally happened again, but it accidentally happened once because we wrote a really, really big check. But that was because our risk appetite was really, really high. We took a squint at the business and we're like, yep, no brainer. Here's some cash. And then because of the check size alone, because it basically was more than 50% of that round at the time, the founder was then able to say, we've got a lead. And so everyone else followed along, but the due diligence didn't follow. And I mean, it's turned out to be a fine investment.
Okay.
Like I'm not mad about it, but it doesn't, like, it's the process that was wrong, not the outcome. The outcome was still a happy accident, you know. But
well, that's good.
Ideally, we're not being used as a lead unless we're doing it on purpose.
Yeah, that's good. So you thought about you didn't fall prey to resulting, where you know, even though the process wasn't great, still got a good outcome. It's like about focusing on that process to ensure that future outcomes.
We'll be very disciplined when we're leading. And when we're leading, you'll know about it, because if we really have high conviction, you'll happily talk about the fact that we're a lead and we've priced the round, and we'll publish the memo, we'll make it accessible, we'll share all of our due diligence with any prospective investor, we'll jump on Zooms to answer their questions. Like, if we believe in the company, we'll happily turn ourselves into advocates for the round.
We talked about networking a lot, and you had a lot of experience building a community with Startup Victoria, etc. I know personally, networking is something that I find a little bit challenging, because you turn up to events or some kind of function or something like that, and it's just everyone standing around with a drink in their hand, just talking to people that they know. So I would love to hear how you would recommend people go about, like investors, because even in public market investing, you can still build networks, and you can maybe understand businesses better by talking with people who are involved or customers, etc. So what are your tips on getting out there and actually putting yourself out there and networking? What are the small steps people could take?
So as an ambivert, which is...
What's an ambivert?
An ambivert... Side quest real quick. So prior to Euphemia, prior to Startup Vic, I was a consultant at a company called Inventium, which uses organizational psychology and neuroscience to help large organizations basically protect themselves from the disruption of startups. And and so I do know a lot about this stuff. An ambivert is basically you're somewhere in the middle. So you can get a lot of energy from other people and conversations, but it has to be the things that you're interested in. Otherwise, you basically become an introvert and you need to hide away in a cave.
That makes complete sense to me.
Yes. And so for me personally, I always get the best results from networking activities when I'm following my interests. So it's genuine. I have genuine curiosity to listen, because where I think a lot of networking activities go wrong is that people are doing 90% of the talking and 10% of the listening. And I think it should really be the other way around. But listening takes energy, and listening is hard work for our brains. And so you'd be better off finding something to listen to that you're genuinely interested in. And that means you're more likely to ask good questions, and you're more likely to actually form a genuine connection with that person that you're speaking with, to then lead to an opportunity, to lead to a recommendation, to lead to that next thing that you need to do for that thing you're looking to learn about, whether that's you go to an event, or you listen to that podcast, or you read that book, or you message that person on LinkedIn. You sort of follow the breadcrumbs based on your interests, because as we already mentioned earlier in the podcast, like. So if you're talking about the things that you're interested in, you will just naturally find the right places and spaces for your interests.
And that also goes back to your investment process, which is also part of investing in what you're fascinated by or interested in, or it's actually investing what you care about, to put it into your...
For us, it's been what we know and have an unfair advantage in, and then also what we care a lot about.
What you care about,
Now, I did mention earlier I have a bonus thesis for you, so this is probably the right place to mention it. So we had fintech, climate tech, women-led businesses. The last one that we've learned along the way is startup infrastructure. So for a couple of reasons. Number one, that's what I know really well.
What do you mean by startup infrastructure?
Great question. So these are the picks and shovels of the tech sector. So these are companies who are high growth, fast growth tech companies whose customers are high growth, fast growth tech companies. So basically these inception-style tech companies who are rapidly working to serve each other, to help each other go faster, to help each other be better. So one example would be BuildKite. BuildKite is a Euphemia portfolio company, and they basically help the best tech companies in the world test and ship their software. So I can guarantee half a dozen apps that are on your phone in your pocket right now were built and shipped using BuildKite software. So think, I'm not sure how many customer names I can actually say, but if you Google BuildKite and you see the ones on the website, you'll be able to see it. It's an incredible tech company.
That's cool. Excellent. So just before we wrap up, before we started this podcast, you grabbed your phone and said, look, I do not want to get this stat wrong. And I don't think the stats come up. I don't think I've asked the right question to get this stat. I'm super curious as to what it actually was.
Right. So when we were talking about public equities and that part of the portfolio, when it comes to how much we allocate and what the risk appetite is and why do we do public equities and when do we do venture and when do we go private, it's another space that we have an unnatural advantage in. And a normal family office would typically give their equities portfolio to a manager to run on their behalf, and they kind of wouldn't think twice about it. And I mentioned Dom's first ever job was writing share trading software for the ASX. Just to twist the knife a little bit on like why we keep that in-house, Dom's returns on that portfolio since inception, which is 2016, is over 240%.
Right. He's done all right for himself.
He's done very well. He's a bit of a freak in a fantastic way. He's just got amazing results. But again, like each investment strategy is totally unique.
Yeah,
so
but that's very unique to him because he is very comfortable with incredibly high risk.
And that's it, right? Like it works for us because it works for us. And so, of course, if anyone listening is curious and genuinely interested to learn more about investing in startups and investing in fintech, like we'd love to share what we've learned and answer any questions that you have.
If there's any kind of links that you could provide us, I can put in the show notes so they can easily come and find this kind of stuff.
Yes,
so we can do that.
Home base is euphemia.com. And from there, you can join the Euphemia Syndicate and learn more about that. The other place you can go is triplebubble.com.au. So that's the dedicated fintech fund. Now, that is quite interesting because it's a first of its kind fintech fund because it actually includes early stage private fintechs, later stage private companies, and pre-IPO and listed fintechs. So you can invest across all maturity stacks, both private and public, within the one fund. Now, that's quite unique for Australia. It's done in other regions, but it hasn't been done well here very often. And the fintech market in Australia is massive. So we see 50 to 70 new fintechs created in Australia every year. But the majority of venture capital funding goes to fintech. So Cut Through Ventures, which is a leading industry report in the venture space, they publish the top 3 or top 10 investment verticals every quarter. And fintech's always in the top 3. It's normally number 1.
Well, you've got a lot of the banks as well playing in that space, like Commonwealth Bank have 15X. So 15X?
X15 Ventures.
Yeah,
yes,
yeah.
actually just last week we announced that CommBank through X15 Venture, which is their venture scaler arm, invested in Triple Bubble.
Okay. Many moons ago, I used to work with Toby Norton-Smith.
Yes. So Toby led that strategic partnership. So we're happy for that to be out in the wild now.
And he's dodged my invites to come on the podcast several times. So Toby, if you're listening, please email me.
Excellent.
Fantastic. All right. So let's get to our reflections. These are questions that we ask every single person who comes on the podcast. Owen always asks one question. I always ask another one. So I'll start with Owen's. If you could go back and give your younger self one piece of advice about life, business, or investing, what would it be?
I did see this question before coming here, and it is a very pensive question. There's really 2 things, I think, if I just had to cherry pick. The first is that you don't need to do anything differently because it all works out just fine. I'm very happy with where I am. I love my work. I love my family. I love my life. And so, problems can feel really big in the moment, and challenges, can feel like setbacks.
Yeah, insurmountable.
But what we were talking about failure before, every piece of my life that has felt like I'm not on the right path, or that was really effing hard, excuse my French, all led to something better in the end. So I would just say don't do anything differently. The other thing I would say is just to remain calm, because, at the end of the day, like whether it's a good outcome or a bad outcome, like you really do own your internal world. And I think as I've gotten older, I've gotten a lot better at separating my internal world from the external world. And there's a book about the second mountain. I'm not sure if you've
I'm not familiar.
Heard about that, but the tenet basically goes that you spend your whole life, trying to climb this mountain to make the summit, right? Like to get that promotion, to achieve that thing, that status, that whatever, that title, that pay rate, that thing, that asset, whatever that goal is. And then by the time you get to the top of the summit, you're above the clouds, and you can actually see further than you've ever seen before. And from the view of the top, now you actually have the perspective to see that there's a whole other mountain over there. And on the top of that mountain are your loved ones. And you realize that this whole time you've been climbing the wrong effing mountain. So I feel very lucky that I learned that lesson very early in my life. And so, again, if I could just reinforce to my younger self that your focus on relationships and your loved ones, like no one's ever going to write on my tombstone that Judy never missed a meeting.
Fair enough. I like it. It's something that I think you've got a young family.
I have a 13-month-old son.
You have a 13-month
yes.
old, yeah. It's you know what? Someone once said to me about having kids, that as the older they get, like it doesn't get easier, it just gets different. I think that's one of the best sayings I've heard about kids, and it's completely true. So I have a 3.5-year-old, and it's none of it's easier. It's just different. And
totally.
fun.
And I've been told that the problems just get bigger. And obviously, for parents out there who have kids older than a 13-month-old, you'll just know way more than me. But already, like only 13 months old, it's already, it really, like all the cliches are true. Like it just goes by so quickly. And I think I'd seen on my social feed at some point, Mia Friedman from Mamma Mia talking about being a parent as just a series of rooms. And, when you're in that first room, you just can't wait to get to the next room. And, then you finally go into the next room and you're like, oh, what I wouldn't give for just 5 minutes in that last room. And it's very true. I already miss the terrible traumatic newborn stage. I don't want to go back, but I would go back for 5 minutes.
For 5 minutes. All right. So now this is my question that I always ask. Our out of offices are on. We're not going back. We're going to lunch. Where are we going and what are we having? Can be anywhere.
Easy. We are going to Kelso's sandwich shop in Fitzroy, and we're getting the Tuck Shop salad sandwich.
Which one's Kelso's?
Kelso's the sandwich shop just near Bodrigi Brewery, if you know where that is.
Oh, yeah, Bodrigi's it's technically in Abbotsford.
Yes, it's actually much closer to Abbotsford than it is to Fitzroy. Maybe it's some creative branding. I don't know.
There's a bit of Collingwood in the middle there too.
Yeah, maybe I've got the suburb completely wrong, but Kelso's is definitely the name.
Right. Cool. So it's on that little strip near Dr. Morse and all those kind of places.
Yes, and the wedding chapel where I got married, actually. My wife and I got married at a shotgun wedding chapel just down the road.
On Johnson Street.
Yeah, it's amazing.
Wow, cool.
I think they do funerals too, so I don't know.
Full circle. So what? Right, fantastic, excellent. And where are we going to go to, like Victoria Park and just eat it there?
The Collingwood Children's Farm. It is a short walk, and then you can see the goats and the ducks.
It's all right. I'm a member. I can get us in.
There you go. But thank you for having me on the podcast. Like I do mean what I say. If anyone is genuinely curious to learn more, like just find me on LinkedIn, Judy Anderson-Firth, and send me a message if you'd like to learn more. Like we're an open book. A big value of ours is transparency because of that mission secret mission to build more Euphemias. Is family offices are typically very opaque or hard to access, or if you've heard that phrase, like once you've met one family office, you've just met one family office. And so we'd like to change that by being transparent about what we're doing. So a lot of the things we've spoken about, they're all publicly accessible on our website. So for example, the gender investment stats, they're all publicly available on our website. So we publish that data. If you want to learn more, please do reach out.
We will put links to the Euphemia website to your LinkedIn as well in the show notes, so people will be able to go directly there and get in touch with you. Judy, I really appreciate you coming in. This has been fun.
Thank you.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel, or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.